Welcome to Markets Now. I'm Michelle Rook along with Darin Newsom, Senior Market Analyst at Barchart. And we're seeing mostly lower livestock futures over in the grain. Soybeans continue their path lower. Wheat and corn, they're bouncing here this morning. And I got to start off with the soybean market, Darin, because we've seen quite a correction here in the soybean futures, but not only in soybeans, but soybean meal and soybean oil. Is this all just fund liquidation, or is there more to it?
To me, it looks like the bulk of what's going on is fund liquidation. If we go back to the most recent CFTC commitments traders report, and again, I look at the legacy futures only, it's the only one, and in my opinion, the only one that matters. We saw that they were still holding a very large net long position in both soybean, non-commercials were holding a large net long position in both soybeans and meal. These markets just had not been hit by the same sort of liquidation, that we've seen in corn, crude oil, and so many others. So it was more or less, it was just their turn. We started moving through some support levels. Algorithms were triggered. Yeah, we get headlines, but I mean, headlines don't really amount to much of anything. What we're watching here is the actual market moves, and they're just on a slide right now, and we're just seeing this money coming out of the market. Will it return? It's hard to say, but until we start to put the brakes on this, until they run out of the orders and get to a point where they're done liquidating, I just don't see the market changing its mood very much.
But we're also seeing markets implode in China. Basically, their soybean products, their soybeans are down. We've seen rapeseed prices take a hit as well. So you're saying that's fund liquidation in all those areas, not necessarily anything fundamental.
Well, no, I'm not saying that. There are some fundamentals going on. Obviously, in China, we do have the African swine fever hitting the hog markets again, hitting its hog herd again. So, I mean, there are some fundamental keys to these markets as well. And whether or not it's feeding the fire of what else we're seeing, as far as liquidation goes, is fine. But if we look at the U.S. market, I mean, basis is still strong. We saw the May July future spread move to something like a 21 to 22 cent inverse. It's just incredible. We still have incredible demand right now for U.S. soybean supply. So the commercial side's just sitting back, letting funds drive this thing down, and they're buying what they need to when they need to. They're not forced to do anything in here. They can pretty much pick and choose when they want to step into the market.
But the funds are already short in the bean oil market, and man, they have really hit the gas on that thing this week. Why?
Yeah, that is the head scratcher to me, Michelle, because there still seems to be ample demand for bean oil, both domestically and worldwide. But that market really has collapsed. And to me, that was one of the triggers for the soybeans and bean meal on Thursday, was the fact that, we were pushing near limit down in soybean oil. Don't really have a good reason for it. I'm sure some folks out there do. I'm not real sure what it is.
Okay, let's move over to the corn market. Obviously, we're getting a little spillover strength from wheat this morning, but we have seen the big inverse in the market. A lot of this has been due to China business, with more business this morning. How long do you think this is going to continue?
It could easily continue most of the, for the next few months at least. Corn, once we get into the second half of the marketing year, so once we turn the calendar page from February to March, that's when export demand for U.S. corn tends to pick up. And that's what we've seen. And again, just as with soybeans, this May July future spread has just exploded here recently. National average basis has gone to 10 cents over May futures. And, hearing stories from the river markets, we're seeing 20, 30 cent basis jumps just as merchandisers are trying to find some supplies in this very tight supply situation, trying to find some supplies to move down river for export. They're just not there. So, nothing's really changed. This was one of the markets that get hit by heavy liquidation over the last month or so, tied in with all the banking and everything else that caused such a fury. But now it seems to be calming down, and commercials, again, just as in soybeans, are willing to pick and choose where they want to buy and get some coverage on, because there's, we continue to see these sales coming in from China.
Absolutely. What about the wheat market? Some double-digit gains this morning, and obviously we're hearing that Russia may temporarily slow or stop their exports, but is that really driving this, or is this just all technical and money flow too?
Well, this, that's what everyone likes to talk about. They want to point to the headline and get all excited and, hoop and holler and this sort of thing. But if anyone believes any headline coming out of Russia, I feel sorry for them. Second, we knew there wasn't any grain left to steal from Ukraine, for Russia to steal from Ukraine to begin with. There wasn't much wheat harvest last year, and certainly there wasn't much that got planned. So this coming harvest doesn't look so good for Ukraine either. So, Russia's taken what it wants, and now it says, okay, we're not going to ship anything because there's nothing left to ship. I don't know why anyone gets so excited about that. What we have to remember is the non-commercial position in Chicago wheat was incredibly large. They've recently pushed it like 50, 60,000 contracts net short. And just as with soybeans, where we could expect some long liquidation, a short covering rally was going to happen at some point. And it seems like, after Wednesday's head fake or fake out here to the downside, it certainly looks like the buyers have stepped back in.
You bet. We were right for a short covering rally for sure. Financial markets, let's talk about the outside markets and kind of what's going on there now, or where you see us headed now that, we're out of the woods of the Fed increasing their rate 0.25%. There's still fear about another rate hike, in May. And so where are we going to go from here, you think?
Yeah, I think we will see another Fed fund rate hike in May. But if we look at the Fed fund futures forward curve, always fun to say, it's indicating, and it has been indicating, that we could actually start to see some decreases starting in June, so the second half of 2023. That'll make things interesting. Now, just short term, the U.S. dollar looks to have turned a technical corner, may try to post a short-term uptrend now for a while. I could put some pressure on markets like gold that's been just screaming higher as well. So, if we see some buying coming into the dollar, a little bit of pressure on the gold market. I'm still not looking for any long-term trend changes here over the next couple months, but it certainly could happen. And in the background, we still have money wanting to go back into global equities here in the U.S. as well. And we'll see how that plays out.
Mm-hmm. So the meat sector has been beat up as well here, Darin, with the outside market concerns, the banking concerns, whatever you want to tag it on. But it looks like Hogs, how many days in a row we scored new contract lows? We're trying to bounce this morning, but are we starting to finally try to put a bottom in this market? Because we've tried to pick this several times now.
Yeah, I wouldn't want to be the first one to buy back into the hog market. It teaches you that lesson very quickly. Do hogs really need to have been pounded the way they are? Probably not.
No.
Fundamentally, again, just as in so many other markets, we've seen some commercial buying coming in. I think a lot of this was tied to the headline. The headlines of coming out of China. Again, it should not have pushed the U.S. market this low. I still think we've got a solid cash market. We've got solid future spreads. So it looked to be a bit of an overreaction on the fund side. We'll see if it starts to straighten itself out. See if funds start to move back to get in line with fundamentals again.
Yeah. And speaking of fundamentals, we still have very good fundamentals in the cattle complex. But again, the funds were long there. They've been exiting. When do we start to see a bottom in that market or this trend turn?
I think there's still some room to the downside in both live cattle and feeder cattle, predominantly in the feeder cattle market. They got way overbought, and there's a big area underneath them now, what could be called a vacuum. So once we've seen some selling come in, the fundamentally feeder cattle never got that bullish. In fact, the spreads were still bearish. And so, that just leaves a lot of room underneath this market, time and space for it to move lower. And I think that's still a possibility. I would look for another few weeks at least, for the May contract and so on, then the deferred contracts to continue to come down.
Okay. Nice analysis. Thanks for joining us. Darin Newsom, Senior Market Analyst with Barchart, and that's Markets Now.